The wealthiest people in the world don't play by the same rules you do. They never have. And the craziest part? The rules were written for them, by them. The Federal Reserve's distributional financial accounts show the top 1% of American households controlled nearly 31% of all wealth as of 2024. That number's been climbing for decades. Not by accident. Most people hear that and feel helpless. Not you. You're here because you want to see exactly how the game is rigged, so you can use the same playbook. Every year, you don't understand what I'm about to break down. You're hemorrhaging money to people who do. Let's fix that right now. Here's the uncomfortable truth. The 1% didn't build their wealth by working harder than you. They built it by understanding systems you were never taught. Tax codes, legal structures, investment access, lending strategy, all of it hiding in plain sight. Today, I'm pulling back the curtain on the specific mechanisms, the actual tools and loopholes that the wealthy use to build, grow, and protect their money while everyone else plays a completely different game. This isn't conspiracy, it's policy. And once you see it, you can't unsee it. Before we dive deeper, hit like and subscribe so you never miss our videos, and share this with someone who needs to see it. Let's start with the biggest one, the mechanism that touches every single dollar you'll ever earn. Mechanism number one, the dual tax system. You go to work, you earn a paycheck. The federal government takes up to 37 cents of every dollar at the top rate. That's how income tax works for people who trade time for money. Now look at how the 1% operate. Most of their wealth doesn't come from a paycheck. It comes from investments, capital gains, dividends, equity appreciation, and the maximum federal tax rate on long-term capital gains, 20%. Read that again. You're taxed at 37% for working. They're taxed at 20% for owning. Same country, same government, completely different rules. And it's all perfectly legal because that's exactly how the Internal Revenue Code was designed. This isn't an opinion. You can pull up the IRS rate tables right now. Ordinary income, up to 37%. Long-term capital gains, capped at 20. The tax code literally rewards people for making money from money instead of making money from effort. And once you understand that distinction, you'll never look at your paycheck the same way again. If you want to understand how to use these same structures legally to build and protect your own wealth, check out the VYBO Wealth Blueprint. It's our complete system for rewiring how you think about, build, and protect money. The link is in the description. Now let's keep going because it gets worse. But what if I told you the wealthy don't even pay that 20% most of the time? Mechanism number two, buy, borrow, die. This is the playbook the ultra-wealthy use to avoid paying taxes on their gains almost entirely, and it's completely legal. 3 steps. Step 1, buy assets, stocks, real estate, businesses, anything that appreciates in value over time. Step 2, borrow against those assets. Instead of selling investments and triggering capital gains taxes, they take out loans using their portfolio as collateral. Banks love lending to people sitting on hundreds of millions in assets. The interest rates are low, and here's the key: borrowed money isn't taxable income. The IRS doesn't treat it as earnings. So you've got someone spending millions per year without a single dollar showing up as taxable income on their return. Step 3, die. When the owner passes away, something called stepped-up basis kicks in. That's Internal Revenue Code Section 1014. It resets the cost basis of those assets to their current market value at the time of death. All those unrealized gains wiped clean. The tax bill doesn't get deferred. It disappears permanently. Think about that for a second. An entire lifetime of investment growth, potentially billions of dollars, and the tax on all of it, zero. Not reduced, not delayed, gone. This single strategy transfers more untaxed wealth between generations than almost any other mechanism in the American tax code. And most people have never even heard of it. Every time you look at your paycheck and see how much was taken out before you touched a dime, remember this: the people at the top found a way around it decades ago. Let that fuel you instead of frustrate you. Mechanism number 3, carried interest. Fund managers at private equity firms and hedge funds earn a share of their fund's profits. Sounds reasonable, but here's where it gets rigged. That income, which is literally compensation for their labor, gets taxed at the long-term capital gains rate of 20% instead of the ordinary income rate of 37%. They're performing a service, managing other people's money. But the tax code classifies their earnings as investment returns, not wages. That distinction saves them millions every single year. They're doing a job and getting taxed like they're sitting on a beach watching their money grow. You can look this up in the IRS Treatment of Partnership Profits Interest. It's right there in the tax code. Congress has debated closing this for years. It's still open. Draw your own conclusions about why. They call it a carried interest. What it really is, a 17% tax discount for being wealthy enough to manage a fund. Meanwhile, you're paying the full rate on every hour you work. Now here's one that doesn't get nearly enough attention. Mechanism number 4, accredited investor gates. Want to invest in a startup before it goes public? A private equity deal? A hedge fund with outsized returns? You can't. Not unless you qualify as an accredited investor under SEC Rule 501 of Regulation D. The requirements? An annual income of at least $200,000 or a net worth exceeding $1 million, excluding your primary residence. This means the most potentially lucrative investments in the market, the ones that create massive wealth the fastest, are legally off limits to most Americans. The wealthy get first access to the best deals. By the time an investment reaches the public market, the biggest gains have already been captured by the people who were allowed in the door early. You're told to invest in index funds and be patient. And that's solid advice. But the people writing that advice, they're putting their own money into pre-IPO startups, private credit deals, and venture funds you'll never get access to. Not because you're not smart enough, because the law says you're not rich enough. They call it investor protection. But ask yourself, who's really being protected here? The people locked out of opportunity, or the people who want to keep those opportunities for themselves? Stop for a second. We've covered 4 mechanisms so far: the dual tax system, buy, borrow, die, carried interest, and accredited investor gates. Each one alone gives the wealthy a massive advantage. Stack them together, they create a wealth gap that compounds faster than any investment ever could. Most people never learn even one of these. You now understand 4. That puts you ahead of 99% of the population, but we're only halfway. These next mechanisms are how the 1% multiply wealth and lock it down for generations. This is where it gets real. Stay locked in. I picture this. A wealthy investor buys an apartment building for $10 million. The building goes up in value every year, but on paper, they're claiming it's losing value, and the IRS lets them deduct that paper loss from their taxable income. Sound backwards? It's not. It's called depreciation, and it's mechanism number 5. Mechanism number 5. Real estate depreciation and 1031 exchanges. The tax code allows property owners to deduct the cost of their buildings over time through depreciation schedule, even while the actual market value is climbing. They're reporting a loss while making money. That's the system working exactly as it was designed for people who know how to use it. And when they want to sell, they don't just cash out and pay capital gains. They use a 1031 exchange, named after Internal Revenue Code Section 1031. It lets them defer capital gains taxes indefinitely by rolling the sale proceeds into another qualifying property. They can do this over and over, property after property, decade after decade. The tax bill just keeps getting pushed into the future. Some investors go their entire careers without paying capital gains on a single real estate transaction. That's not a loophole, that's the law. Here's the thing most people miss. You don't need to own a skyscraper to use this. Even a single rental property qualifies for depreciation, deductions, and 1031 exchanges. Learn the rules, start using them. Ready for the mechanism that keeps old money old? Mechanism number 6, Dynasty Trust. Some states, South Dakota, Nevada, Alaska, among them, allow trusts that last for centuries, not decades, centuries. They're called Dynasty Trusts, and they let wealthy families pass assets from generation to generation while sidestepping estate taxes almost entirely. This is how old money stays old money. It's not luck. It's not talent passed down through bloodlines. It's legal infrastructure that most families don't even know exists. And while you're trying to figure out how to save enough for retirement, these families already have their great-grandchildren's wealth locked in. Ask yourself why nobody taught you this in school, because the answer tells you everything you need to know about who the education system was designed to serve. Two families, same net worth today. One sets up a dynasty trust, one doesn't. 3 generations later, one family still has wealth. The other watched it get eaten alive by taxes and legal fees. Same starting point, completely different ending. The only difference was the structure. If you're serious about understanding wealth at this level, consider joining the VYBO channel membership. You get exclusive content, early access to videos, and a community of people who refuse to stay uninformed about how money really works. Link is below. Let's finish this. This next one is the quiet part out loud. The mechanism behind all the other mechanisms. Mechanism number 7, lobbying and policy influence. The 1% don't just benefit from favorable tax policy, they help write it. Corporations and wealthy individuals spend billions of dollars on lobbying every single year. That's public record. You can look it up on the Senate's Lobbying Disclosure Act database. They fund campaigns. They hire former government officials. They place people on advisory boards that shape the regulations affecting their industry. When a single tax provision saves an industry billions, and that industry spent a fraction of that amount lobbying for it, that's not corruption by any legal definition. That's just how the system was built to operate. The people with the most resources have the most influence over the rules. Always have. And until you understand that, you'll keep wondering why the game feels impossible to win. The rules aren't rigged behind closed doors. They're rigged in committee hearing. In legislation you'll never read. In tax code, amendments buried in 1,000-page bills. And every single one of them affects your paycheck, your investments, and your future. That's why knowing this matters. One more, and this one ties the whole system together. Mechanism number 8, stock compensation and tax-free wealth loop. Executives at major corporations often receive the bulk of their compensation in stock options or restricted stock units rather than cash salary. Why? Because stock isn't taxed until it's sold. And as we already covered, they don't need to sell it. They borrow against it. This creates a loop. Earn stock, watch it appreciate, borrow against the gains. Spend the borrowed money. No sale means no taxable event. No taxable event means no tax bill. The wealth keeps growing while the IRS collects nothing on those gains. Combine this with stepped-up basis when they die, and the entire cycle repeats for the next generation. Earn, borrow, pass it down. The gains are never realized. The taxes are never paid. It's a closed loop designed to keep wealth compounding inside the same families indefinitely. Now here's what you do with this information. You stop being angry about it and start being strategic. You can't change the tax code tomorrow, but you can start structuring your money the way wealthy people structure theirs. Learn about capital gains. Open tax-advantaged accounts. Start building assets instead of just earning income. You don't need to be a billionaire to use these principles. You just need to know they exist. And now you do. So here's the real question. Now that you see how the game actually works, what are you going to do about it? 8 mechanisms, not theories, not conspiracies. Legal structures built into the system itself. A dual tax code that rewards owning over earning. Buy, borrow, die erasing taxes across lifetime. Carried interest disguising wages as gains. Accredited investor rules locking you out of the best deal. Real estate depreciation and 1031 exchanges, deferring taxes indefinitely. Dynasty trusts protecting wealth for centuries. Lobbying shaping the rules from the inside. Stock compensation creating tax-free wealth loop. The game is rigged. That's not the question anymore. The question is whether you'll keep playing by rules that were never written for you or finally learn the actual playbook. Your move, make it count.